Hello and welcome back to All Things Money. I'm your host, David Blaine. Thank you for joining us today. During the first segment, we talked a little bit about tax law in America and the fallacy of trying to target specific groups for either a higher tax or a specific benefit, that within a couple of years it's widespread avoidance on the one end and widespread abuse on the other end. During this segment, we want to talk a little bit about high-earning folks in America and some of the pitfalls that go along with this. Now, this applies across the spectrum. The rules or the statistics somebody's talking about are mostly related to the 1% of Americans that earn a very high income, but it applies across the board. And one thing that I've learned, I do a lot of charity work. I'm involved in a lot of organizations that do great work about helping the poor and underprivileged people. And one of the things that we found is that in America, they say, oh, the poverty rate is, say, 10% or 20%. Well, when they do long-term studies of that population, what they find is that from one year to the next, it's not the same people. That America still is a mobile society, that looking at out 1 year, 2 year, and by 3 year, in North Carolina, the average family that stays in poverty is only about 1.9%. So we see through the help of different charities and things like that, we see that people are able to lift themselves out of poverty. At the same time, people are going backwards and into poverty, so there's always going to be that need to help people. And what I want to talk about today is, believe it or not, the same thing happens at the other end of the spectrum. Looking at data for the top 1%, which is those earning just say roughly $350,000 or more, their income fell by more than 30% from 2007, where the average income for the bottom 90% fell less than 3%. So I know you're all out there crying, the income went down. The point of this is not is to illustrate the extreme volatility not only of the income of the wealthy, but also the way they fall in and out of the wealthy. And then we're going to talk about how to prevent that from happening to you. Even if you're not in the top 1%, the same thing happens for, say the top 10, 15, 20% of Americans as well. So the other thing, according to the Federal Reserve study, found that a third of the people, a full 33% of the people in the top 1% in 2007 were no longer in the top 1% in 2009. So in a mere span of 2 years, 1/3 of the people that were in the top 1/3 were no longer in it. So there's a lot of mobility at the top, both people moving out of it, but also I want you to understand too that if 1/3 of the people went out of the top 1%, well, guess what? A new 1/3 of the people went into the top 1%. And you see this happen at both ends of the spectrum as well in the middle, that people's wealth and financial stability can be quite volatile but it's exacerbated at both ends of the spectrum. And we talk about beta. Beta is a measure of how, when talking about the stock market, if you have a company like Coke and you have the stock market, if Coke goes up at roughly the same rate as the market or goes down at roughly the same rate of the market, you would say it has a beta of 1. It measures how closely that stock goes up and down with the market. And so a company with a beta of, say, 2 would be very volatile. That means if the market went up $1, this stock would go up $1 or up $2. If the market went down $1, this stock would go down 2. So beta is a measure of the volatility. Well, what they found was that the volatility of the top 1% of the people, their beta is 3.96. And basically what that means is that for every dollar change in the value of the stock market, their wealth is changing 4 times that. So if the market goes up by $1, they go up by $4. But if the market goes down by $1, their wealth goes down by $4. Extremely volatile. We haven't seen this type of volatility in wealth, I don't think, ever in history. And we see these stories of people like, Donald Trump and real estate developers and hedge fund managers that make a huge amount of money one year, and the next year, they're filing for bankruptcy. And this is due to the high volatility or beta of their income and their wealth. So what we want to talk about, obviously, is how to prevent that from happening. And what are these folks doing that causes them to fall out of that? Or likewise, if you're trying to move up the income or wealth scale, what do you do to preserve that wealth and grow that wealth? And there are a few key things that I thought of from my experience over the years and reading and things that came to mind. One of them is what we call is simply spending. The second thing is leverage. Big spending, big leverage. And we're going to talk in the third segment, we're going to talk more about these. I just want to highlight them here. We're coming up to the next break. So we've got spending, we've got leverage, we've got over-concentration, all their eggs in one basket. We've got family issues, things like divorces, family business, that kind of thing. And then the last one is sort of a combination of all of them, the toxic mix of betting big on a specific investment using leverage to fund a lifestyle. And that sort of creates the problems of why these folks go in and out of the top 1% at such a high rate. It can also apply to people further down the income scale. So we're going to talk about those in more detail. We'll also lay out some principles of how to, not only what to avoid, but what to do to keep and preserve your wealth. And that's what my firm is all about, growing, keeping, and preserving your wealth. So for All Things Money, we'll be right back after another break, and we'll continue talking about this topic.